Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Before we get started, today's video is going to be a shortened, condensed version of what we usually do in our SPX videos. So in this particular video, we're not going to go over all the different aspects of the indicator. We're mainly just going to go over today's trades for this particular session. If you are not familiar with the SPX Daily Key Levels indicator, then look in the description of the video underneath the video on YouTube, and you will see in the description these particular links that go into more details about how the indicator works and the trading strategy. So there's a video overview as well as additional resources with a Google Drive link for descriptions, links to other videos on different topics about the SPX indicator, and then there's also links to longer that are hour to an hour and a half long SPX trading videos that will go into a lot more detail about the indicator and the daily key levels strategy. If you click on this Google Drive link, we'll show you what screen that takes you to. That'll take you to this particular document, which will have links to other specific topics that are covered about certain aspects of utilizing the indicator. Thank you. Hello, in today's video we'll be taking a look at the Thursday, January 29th, 2026 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the newest version of the indicator, the V2.0 version, which was just released a few months ago. Okay, so some of you may be already familiar with how this indicator works from seeing our other videos on this channel, but for those of you who are new to the channel, who have never seen any of these videos before, I will briefly run over how the indicator works and what the different levels are presented on the chart. However, as indicated in the preview to the video, we do have links to other longer session videos which go into more detail about how the indicator works, and there's also a Google Drive link in the description of this video that if you click on that, it will take you to a document that has various topics about this particular indicator, and then also longer videos on those specific topics. Today's video is going to be more of a condensed video, which we will go over briefly how the indicator works and then the trades for today. So if you do want to see the longer session videos or the videos on the other topics, then please refer to the description of this video. Okay, so the way this indicator works is that it works on the TradingView platform only. What that means is that you can only use this indicator for use on the TradingView platform. However, you can place your trades as far as your SPX option trades on through whatever broker that you want. It's just for using this indicator, you need to use it on the TradingView platform. So if you have a brokerage account open with Thinkorswim or TradeStation or Robinhood or Webull or E-Trade or Merrill Lynch or what have you, you can still place all your trades through those brokers like you usually do. It's just you're using this indicator on the TradingView platform. Okay, so this indicator works on two different SPX symbols. The first symbol that it works on TradingView is the SPX CBOE index. So on TradingView, under symbol search, you would simply type in SPX and then look for the SPX symbol under the CBOE exchange, and that is the symbol that we have it on now. The other symbol that it works on is for Forex traders or for people taking trading challenges with Forex-based trading challenge companies in which you can only trade SPX via Forex through a Forex CFD version of SPX. So in that case, you would not be trading SPX index options. You would instead be trading the Forex CFD version of SPX to your Forex broker. And the symbol that it works on for that is the SPX 500 under the 8-cap exchange. So on TradingView, you would type in SPX 500 and look for that symbol under the 8-cap exchange. One advantage for those people who are trading SPX index options to open up a second chart with SPX 500 8-cap is that with that particular symbol, you can see an additional table on that chart, which will give you the levels for the SPX CBOE index 30 minutes before it opens at 9:30 a.m. Eastern. So you get those levels on your screen at 9 a.m. However, when you use it on the CBOE SPX symbol, the levels will be on that chart at the first tick of the 9:30 a.m. Eastern New York time open. So for example here, we're on CBOE SPX, and so the levels that you would see on your screen are what would be showing at 9:30 a.m. Eastern New York time. Now we've turned on some of the additional levels here, specifically these midpoint levels, because of the way price action panned out during today's session. For the default display of the indicator, the default levels displayed are at 9:30 a.m. unless you change what you want the default to be, is the SPX Bull Bear KPL. That's the most important bull bear key price point and key level for the different key levels that the indicator presents. So generally speaking, that is a bullish bias above and a bearish bias below. However, you can still take bullish or bearish trades with this indicator off of any of the main key levels. So with the V2.0 indicator, your main key level is the bull bear KPL. Your other main key levels on the V2.0 indicator are going to be your R1 through R6 levels and your S1 through S6 levels. So keep in mind that with this indicator, you can take bullish or bearish trades off of any of the main S levels below the bull bear KPL, or bullish or bearish trades off of any of the main R levels above the bull bear KPL. And of course, depending on price action, you can take a bullish or bearish trade off of the bull bear KPL as well. The QL levels that you see here are just enabled for above and below the bull bear KPL. The QL levels can be enabled above and below each main level. You would do that in the user control panel of the indicator, but on the default display, unless you change the default, what you want to save the default display as, only the QL above the BBKPL and QL below the BBKPL are shown on the default display. The midpoint levels shown on the default display are the first midpoint level above the bull bear KPL and the first midpoint level below the bull bear KPL. The other midpoints are also available to be enabled in between each of the S levels and in between each of the R levels. And you would simply do that in the user control panel if you wish to turn those on as well. The levels that you see here are the PMH, PML, YDH, YDL, and YDC. The PMH is the pre-market high. The PML is the pre-market low. The YDH is yesterday's daily high, specifically the previous session's RTA session high. The YDL is yesterday's daily low, specifically the previous day's RTA session low. And the YDC is yesterday's daily close, specifically the previous day's RTA session close. These key levels also play an important role in the overall context of any given session. So for example, For there to be any significant move to the downside, not only is price going to have to start closing below the bull bear key price level and holding below that, but generally in most sessions it's also going to have to start closing below the pre-market low and holding below that for any significant downside move to occur. Conversely, on the pre-market high, it's the same thing in reverse. For there to be any significant upward action in the session, as far as bullish action, generally speaking, you're going to have to start closing above the bull bear KPL and holding above that, and also closing above the pre-market high and holding above that for there to be a significant move to the upside. The YDL, YDC, and YDH levels are also important for context of the session, as typically in a lot of sessions they will be stopping points or points where moves may stall or start reversing. However, if the price breaks through decisively through any of those YDC, YDL, or YDH levels and holds and starts continuation moves above that, then you can see significant moves to the upside or downside based on it closing above or below those levels decisively and holding above or below those levels. There are two different types of trades that you can do with this indicator. One is scalp only trades and the other is regular trades, which we will see here in a few moments when we get involved with the trades. But before we get involved in looking at the trades for today, I'm going to go over one more thing, and that is the default look on startup. So as you can see here, we've moved where we're just looking at R1, and because of the way the session progressed throughout the morning session, we are loading up the levels below that, so this is tainted to show from R1 down to S6. Generally speaking though, when you start a session, you want to have somewhere between R2 and S2 as the beginning part of what you want displayed on your chart. And you'd also like to see all 5 of these PMH, PML, YDC, YDH, and YDL levels. So to do that, you simply go over to your right price axis here, and you left click and hold on to the mouse, and you can, as you can see here, if we have all 6 levels, it looks very squunched up. So at the beginning of a session, at the 9:30 open, what you simply do is to go back to the right price axis, and you simply drag your mouse up. And as an example, if we were at the start of the session, we would want to see something along the lines of this, where we have R2 down to S2, and since YDL is close to S2, we would have R2 down to YDL. However, as you can see that quickly in this session, price began to rapidly move to the downside. So in that case, we want to move up, and we scroll down as price continues to move down, and we open up our additional midpoint levels between the S levels to help us gauge level-to-level trade management of our bearish trade that we did at the beginning of the session. Okay, so now we'll move on to looking at the trades of the session. Okay, so here we're going to look at the trades of the session. As you can see here, we have the notes on the chart. We also have the ask data boxes for the entry candles, and we have over here the various levels that it hits with the bid prices specifically for the candle closes on each one of these level hits. Okay, so first off, we have the 9:30 a.m. candle marked off here. We're on a 2-minute chart. With this particular daily key level strategy utilizing this indicator, the recommended chart time frames to use are going to be anywhere from the 1-minute chart time frame up to the 5-minute chart time frame. However, you'll see on most of our videos on SPX trading, utilizing this indicator with this strategy on this YouTube channel, that we utilize for our session videos, the 2-minute chart, as we have found that to be the most consistent performer for this particular strategy. However, if you prefer the 1-minute time frame or the 3-minute time frame or the 5-minute time frame rather than the 2-minute time frame, that is fine as well, especially if you prefer to use this particular indicator in conjunction with some other indicators that you may also like to use as far as giving you additional confirmations of any entries that you would like to utilize with this particular indicator, or for helping you to manage trades as they move from level to level. However, just keep in mind that we have found that the 2-minute chart time frame out of that 1-minute to 5-minute range works the most consistently for this particular strategy. Okay, so we have the 9:30 a.m. opening candle. As you can see here, it opens below, tries to wick up to the bull bear KPL but doesn't, and ends up closing below the bull bear KPL. So that is our bearish entry signal for the 9:30 a.m. opening candle. With this particular indicator, the 9:30 a.m. opening candle trade is part of the daily key levels trading strategy with this indicator. However, it is not mandatory for you to take the 9:30 a.m. candle trade, and is simply an optional trade. If you prefer to let the session play out more before making any trades, as an example, you could have instead entered on some of the succeeding candles for a bearish play off of S1 instead of a bearish play off the 9:30 a.m. candle on the bull bear KPL. Or you could have entered on one of these candles here for a bearish play off of the S2 level, just as an example. So you do not have to take the 9:30 a.m. candle trade if you do not want to. It is an optional trade under this strategy. You can simply wait for price action to play out to a specific time or period of the session that you prefer trading in, and then based on what price action is doing at the particular level in question, particular main key level. Again, the main key levels are bull bear KPL, R1 through R6, and S1 through S6 as far as taking bullish or bearish trades. And at that time, later in the session, depending on what the price action is doing at one or more of those main key levels, you can then decide whether you would prefer to take a bullish or bearish trade off of those levels at that time. However, for those that prefer taking the 9:30 a.m. opening candle trade, which is what we prefer to do, then on this particular candle, this is a bearish entry off of the BBKPL level on the 9:30 a.m. candle close. Now, the most important aspect of this candle is that it is closing below the bull bear key price level, and it is also closing within the acceptable range for a BBKPL level based bearish trade. What the acceptable range means is there is an acceptable range on any of the key level trades. So on any bullish or bearish trade off of any of the main key levels, there is an acceptable range that the candle close can be within, and if it is within that acceptable range, then you can take a trade off of that level, whether it happens to be a bullish trade on a candle closing above that level or a bearish trade for a candle closing below the level in question. And there is a specific video and a PDF document on this particular topic of inside the acceptable range and outside the acceptable range, which you can find on the Google Drive link in the description of this video, which has links to descriptions of other topics on this indicator and videos on those topics. And within that document, you will see one section that is on 9:30 a.m. opening candle trades, and also what is within the acceptable range and outside the acceptable range. And there's an accompanying PDF document that goes along with that video, which also explains that in greater detail, and also that emphasizing that that also not only applies to 9:30 a.m. opening candle trades for the BBKPL level, but also bullish and bearish trades, with specifically to the acceptable range portion as well. Okay, so we have the bearish trade entry here. Now, what about our stop losses? The stop losses are based on the level that you're taking the trade on and the type of trade. So in this case, we're taking the trade off of the SPX Bull Bear KPL level. So our stop losses are going to be the QL level above or the midpoint level above the Bull Bear KPL. The standard stop loss is the first midpoint above the level that you're taking the trade from if it happens to be a bearish trade. If instead this was a bullish trade, then the standard stop loss would be the first midpoint below the Bull Bear KPL. But this is a bearish trade, so it's the first midpoint above the Bull Bear KPL for the standard stop loss. For those that prefer to use tight stop losses, the tight stop loss on this bearish trade from the Bull Bear KPL level is the QL above the BBKPL, which is this level here. If this was the reverse and it was a bullish trade off the Bull Bear KPL, then the tight stop loss on that would be the QL below. And it works the same off of the other levels as well for bullish and bearish trades. If you were taking a bearish trade off of S1 as an example, then the standard stop loss would be the first midpoint above. Tight stop loss would be you would turn on the tight stop loss if you prefer to use that, and you would turn on the tight stop loss, which is the QL above S1. Same thing with S2 for a bearish trade off of S2. Midpoint above S2 is your standard stop loss. QL above S2 is your tight stop loss. And it works in reverse for bullish trades. Your standard stop loss in a bullish trade is going to be the first midpoint below, whereas the tight stop loss is the QL below the level you're taking the bullish trade from. Okay, so your entry stop losses are level based. Now what about your option strikes? With this indicator, you're always going to have 3 different alternatives for the strikes that you could consider on any bullish or bearish trade. So I'll explain what it is for this particular trade, but this would also apply to other trades as well. So how you figure that out is you take the level that you're taking the trade from, in this case the Bull Bear KPL, 69.95.96. What type of trade is it? Bearish trade. So the standard play is going to be the strike that is closest to the level that you're taking the trade from. Since this is 69.95.96, the closest strike to this level is going to be the 69.95 strike. Since it's a bearish play, it's the 69.95 put. Now what about our 2 other alternatives? The 2 other alternatives are going to be out of the money alternatives. And how you figure that out is you take the level you're basing the trade off of, the Bull Bear KPL in this case. What's the direction of the trade? Down, since it's bearish. So we simply look down to the first midpoint level below the level we're taking the trade from. 69.89.06. What's the closest strike to that? This 69.90 strike. So the first alternative would be the 69.90 put for this particular bearish trade off of this level. What's the furthest out of the money strike you can consider on this trade? Again, we look at the level we're taking the trade from, and we look 1 full key level below, and that is the S1 level, 69.82.16. So we would use the strike closest to the S1 level, which is the 69.80 strike. So that would be the 69.80 put in this case, since this is a bearish play. You're entering your trades on the close of the candle, because we want to confirm where the candle is actually closing. If this candle had instead shot up and closed above the bull bear KPL, and we were inclined to take the 9:30 a.m. opening candle trade, then we would instead be looking at a bullish entry signal, and we would be looking at a bullish play, which would be call options instead, and then we would do the same thing in reverse. This would be a 69.95 call option. First out of the money would be the closest to this midpoint above, 7,286. So that would be the 7,005 call strike. And our furthest out of the money on a bullish play from this level would be the closest to the 7,976 level. So that would be the 7,010 call. Okay, back to this specific trade. The 69.95 standard play put option. The ask price on the 9:30 a.m. candle close is $20.50. The first alternative, the 69.90 put option, the ask price on the 9:30 a.m. candle close is $18. The furthest out of the money strike and our last option strike to consider on this bearish trade is the 69.80 put option. The ask price on the 9:30 a.m. candle close $13.80. Now, as mentioned earlier, there's two different types of trades you can do with this particular indicator and with this particular daily key level strategy, which is an intra-session day trading strategy. One is scalp only trades and the other is regular trade. Scalp only trades require a one level move in your favor to exit the trade 100%. And that means exiting the trade on a scalp regardless of whether you have one option, two options, three options, 5 options, 10 or 20, etc. On scalp only trades, you're looking for a quick in and out. You're not adjusting your stop loss. You're not doing any scaling out. You're simply closing out all contracts when the one level move in your favor has been met. And in this particular case, the one level move in our favor was met on the next candle. As you can see here, it hits S1. S1 is one full level below in our favor from where the trade was taken from, the bearish trade. Look one level below, that's S1. That is your scalp exit, as that is a one level move in your favor. The length of the level move in your favor is calculated by taking the level that you're taking the trade from to that specific level. So even though this trade started, as you can see here, the candle below the bull bear KPL, for purposes of calculating the exit for the scalp and for other trades, you're calculating it from the level that you took the trade from in the direction that you took in the trade, in this case bearish. So a one level move is S1 from the bull bear KPL. So that is your scalp exit. Here are the data boxes for the bid prices at the candle close here. The 69.95 put, 23.20, profit $270 per option on the scalp. 69.90 put, 20.50, profit $250 per option on the scalp. 69.80, $15.90, profit $210 per option on this scalp only move. Now, a regular trade requires a minimum 1.5 level move in your favor for a regular trade. A regular trade also differs not only from the level move required from the scalp, but with a regular trade you have three different options as far as how to handle managing that trade once it hits the minimum 1.5 level move in your favor. Those three options are going to be A, you can either close out 100% of your contracts, just like you did with the scalp. So when it hits this 1.5 level move, you can simply close out all contracts, and that is the end of that trade. And if you still want to trade the rest of the session, then you can look for an additional trade opportunity. However, the second option would be to instead adjust your stop loss to break even or break even plus an initial profit buffer of generally 10 to 15% on top of break even. So at this point, you would switch from a level-based stop loss to now a price-based stop loss when it hits the 1.5 level move in your favor if you're doing a regular trade. So in this case, on the bid price on the candle close here, I was taking the example, the 69.95 put, $26.50. We paid $20.50, so adjusting our stop loss to break even, if we're inclined to do that, is adjusting it to $20.50, as that is what we paid, so that's the break even. Or adding 10 to 15% on top of that if you want to add a initial profit buffer on top of this 20.50. So for example, 10% would be $2.05. You could just round it down to $2 and just say it's $22.50. 15% would be roughly $3, so that would be $23.50. Now at this point, the 69.95 put on the bid on the candle close 26.50, that's a profit of $600 per option. The 69.90 bid on the candle close 23.60, profit $550 per option. And the 69.80, $18.60, profit $480 per option. Now the third option only applies if you are trading 3 contracts or more, and that would be a scaling out method in which you would close out somewhere between 70%, approximately 70% to 90% of your contracts, and then you would adjust your stop loss on the remaining runner contracts to either break even or break even plus a 10 to 15% initial profit buffer. So for example, if you had 3 contracts, you close out 2 of them and you leave 1 runner, and then you adjust the stop loss on that remaining 1 runner. If you had 5 contracts and you exited 4, then you are scaling out of 80% because 4 is 80% of 5, and on the 1 remaining runner you adjust your stop loss on the remaining runner. If you had 10 contracts, then you have a little bit more flexibility, so 7 would be 70%, 8 would be 80%, and 9 would be 90%. So for example, if you had 10 contracts and you closed out 7, then you have 3 contracts as a remaining runner to adjust the stop loss on. Then with the regular trade, at each particular level that it hits further in your favor, then you have the same 3 options as it hits each succeeding level move in your favor to either exit or adjust your stop loss or to adjust your scaling out. So for example, here at 942, it hits not only the S2 level, but the YDL level. Now going back to this trade here just for a moment, just to clarify, this is a 1.5 level move. So as we did before, where did we take the trade? Where did we take the trade from? The bull bear KPL. It's a bearish trade. We look down. That was the 1 level move in our favor scalp. Next half level down, that's the 1.5 level move. Now on this, on that hit of the S2, we have a 2 level move in our favor. 1 level, 1.5 levels, 2 levels. Now it also hits the YDL level and closes through it. Now normally the YDL level would be an additional waypoint for decision making. However, in this case it hit both of those in the same candle. Because if any one of these levels here happen to be in the direction of the move in your favor and they occur after the 1.5 level move threshold has been met on a regular trade, these levels, in addition to half point, midpoint levels, and main levels, become additional waypoints for decision making. It just so happens in this particular session, in this particular case, it took out both of them with the 1 candle. If it instead had only taken this level out, then when it hit this level, if it did end up hitting this level, then that would be another decision-making waypoint. Then when it hits this midpoint level, then you have another one. Then when it hits this main level, another one. Midpoint level, main level, and on and so forth. Okay, So here are the 9:42 a.m. candle data boxes here with the bids on the candle close. The 69.95 put 38.70, profit $1,820 per option. 69.90 put 35.10, profit $1,710 per option. 69.80, 28.60, profit $1,480 per option. Here, as you can see at the 9:44 a.m. candle, it hits the mid S2, S3 level. That is now a 2.5 level move extended. 2.5 level extended move. The bid prices on the candle close, 69.95 put, 43.70. These are all here for the 9:44 a.m. 43.70, profit $2,320 per option. 69.90 put, 39.80. Profit $2,180 per option. 69.80 put, $32.90. Profit $1,910 per option. Then here on the 10 a.m. candle, it's the mid S3, S4 level. Oh, uh, my apologies. I skipped over one here. 9:58 a.m. is the next level hit here, so my apologies. It hits the S3 level. Now that is a 3-level move, extended move. 69.95 put, 57.10. That is this row here, 9:58. Profit now $3,660 per option on that. 69.90 put, 52.60. Profit $3,460 per option. 69.80, 44.40. Profit $3,060 per option. So as you can see here, if you hold some runners through the different levels, then you can start multiplying your profits exponentially if we happen to get a move like we did today, in which we get a very large extended move. On the 10 a.m. candle here, it hits the mid S3, S4. That's now a 3.5 level extended move. The data boxes are here for that, the 10 a.m. 69.95 put, 69.30. Profit $4,880 per option. 69.90 put, 64.70. Profit $4,670 per option. 69.80, 56.20 on the bid. Profit $4,240 per option. And then here at 10:14 a.m. we have this hit of the S4 level with the bounce back up. So we have a touch with the bounce back up. Now a 4-level extended move. Bid prices are here on the candle close. However, if you were taking your profits based on the touch, it would have been a little bit higher, and that would be basically the highs of these instead of the close. However, generally speaking, it's best to keep everything consistent. So if you're getting out on closes, it's best to just keep getting out on closes. If you're going to get out on touches, then just do everything on touches. However, that is up to the individual trader, however they prefer. Okay, so these are based on the candle close, just like the other ones. 69.95 put on the 10:14 a.m. S4 hit. 75.10 on the bid on the candle close. Profit $5,460 per option. 69.90, 70.30. Profit $5,230 per option. 69.80, $61. Profit $4,720 per option. Now, as you can see here, we did not continue on with the various data boxes and comments through these here. But as you can see, after here, it went back and re-hit this level several candles later and then made a move down after closing below this level to then seek out the mid S4, S5 level. So that would now be a 4.5 level extended move. And then it comes down here at 10:50 a.m. and you have the hit of the S5 level here at 10:50, and then here a few candles later you have the mid S5, S6 hit. Now we just did one candle here. This is for the furthest out of the money, what started at 1380. The bid price on the candle close here is $100.40. So that's roughly $86.60. So that would be $8,660 profit per option here. Now remember, this is the 69.80. So if we're looking at the 69.90, then you would add roughly $10 to this, because here they're so far in the money here, they're basically moving in lockstep with the SPX. So the 69.90 would be roughly $110 to $111, whereas the 69.95 would be about $15 higher than this, so between $115 and $116. So you can see how profits can exponentially enlarge if you're holding runners through these. Now you could adjust your stop losses only through all of these. However, that is the only option you have if you're only trading one option. Because with only trading one option, then you really don't have any scaling out opportunities. You're either in the trade or you're out. So that is your only option if you prefer not to exit in any one of these previous levels and you want to keep seeing how far this can go in your favor. Then you would just have to keep adjusting your stop loss as it continues to move down each level, or if you prefer, rather than do each level make an adjustment, or each waypoint making an adjustment on each particular level step move in your favor, you could instead just confine it to one full level moves in your favor for adjusting your stop loss if you prefer to that, rather than micromanaging it for every particular level. So that's up to every individual trader as well, how they would like to make their stop loss adjustments on any runners, or if they're just holding one contract. Okay, so that's going to wrap it up for this video. As we mentioned in the preview at the beginning of this video, if you are interested in purchasing this indicator, you can send us an email at daytradinggps@gmail.com. And in return for you taking your time for watching this video today, you can request a discount promo code to purchase this indicator, and we will send you a promotional discount code that is good for a substantial discount on the purchase of the indicator. All of our indicators currently are sold on a one payment for lifetime access basis. That means you make one payment, then you have access to the indicator for life. There's no monthly fee or any other fee with a lifetime subscription, just simply the one payment up front, and then you have access to the indicator for life. Also, lifetime access includes any future updates to a particular indicator, or it also includes any additional versions of the indicator which come out later, which add additional features. So if we come out with an additional version of this indicator, which we are planning on releasing a v3.0 version very soon, they will have many new substantial features added to it. And when that v3.0 version comes out, the price will be going up substantially. So if you purchase the v2.0 indicator today with lifetime access, you can purchase it at the lower base price and also request the promo code to get a lower price on your purchase. And then when the 3.0 version comes out, or any other version after that in the future, you will be getting those at no additional charge and have lifetime access to those as well. Okay, so thank you for taking the time for watching this video today. We appreciate your support of our channel. If you like the video, please hit the like button, as it helps us with the YouTube algorithm. So we'd appreciate that. And if you'd like to be notified when we post any new videos on this channel about this particular indicator or any of our other indicators, then please hit the subscribe button and you'll be notified of any new videos posted. Thank you, and we wish you much prosperity in all your future trading.